Hey everyone, Ben Nelson here, also known as the Everyday Real Estate Investor, which, by the way, if you haven't checked out the podcast, definitely make sure to do that. We talk about how to get into the real estate investment game, even if you have a busy career or other things taking up your time, and we talk to other investors who've been able to do that same thing. We also talk about strategies and tools to be more effective, as well as the all-important topic of mindset to help you be a more successful investor. You definitely don't want to miss it if you're looking at getting into the real estate investment game or if you're wanting to scale your current real estate investment business. By the way, don't forget to hit the subscribe button so you can continue to get updates on new podcast episodes as well as market updates like this and other content. Well, there certainly is a lot going on in the market right now, from impacts from the Russia-Ukraine war to rising interest rates to continued struggles with the supply chain. So what does that all mean for the housing market? Well, some continue to pitch the narrative of the coming housing market crash. My feeling is a lot of these people have in the rearview mirror. In other words, they're looking back at what happened in the financial crisis of 2007, 2008, and they're equating that to where we are today, as if we're looking at the same scenario again. In reality, so many things are different, of which are a huge shortage of housing, being short an estimated 5 million units or more, and no short-term ability to narrow that gap, a large pool of millennial buyers, and much better lending practices than what we had prior to the financial crisis. While a slowdown, especially in a rising interest rate environment, is certainly possible, I mean, did anyone really think 15 to 20% annual appreciation was sustainable long-term? A crash seems unlikely. NAR reported that pending home sales dropped in March, the fifth straight month that pending home activity has declined, suggesting that a slowdown has certainly hit. However, not all down numbers are equal. When you're comparing against all-time highs, down can just mean heading into a direction of more normal activity. Another factor is that with extremely low inventory levels, it's pretty hard to continue to have an increase in pending sales activity when there isn't even enough on the market for those numbers to be able to increase. And even with this slowdown of pending sales, home prices have continued to climb. Not to mention the fact that this is also during a time when interest rates are steadily climbing, and we still continue to see enough activity to spur rising prices. NAR chief economist Lawrence Yun recently stated that the falling contract signings are implying that multiple offers will soon dissipate and be replaced by much calmer and normalized market conditions, and that home prices are in no danger of decline on a nationwide basis, but the price gains will steadily decelerate, meaning that prices coming down is unlikely, but more historically normal activity and appreciation is likely to be the case. Here in the Portland, Oregon metro area, inventory, which is currently at an astoundingly low 0.7 months of inventory, continues to be a huge problem, having been under a month and a half of inventory for almost 2 full years and under 1 month for the majority of that time. There simply is not enough homes to meet the current demand, and development of new product is slow to come online. We are seeing more new construction inventory, but so far it's not enough to make a dent in the inventory levels in any significant way. Labor and material shortages, rising costs, and supply chain constraints continue to be a struggle. It's likely that builders will finally start to feel a little bit tighter margins as those costs continue to increase while higher mortgage rates start to pull back on the rising housing prices. For the past few years, builders have been able to just pass along those increased costs and keep their margins higher. In markets where affordability has become more of an issue, that ability to pass those costs increase along to the consumer may be coming to an end, or at least be on a more neutral ground. Keep in mind that, as we've all seen in the news, inflation is at its highest levels we've seen in decades. While those levels of inflation probably won't continue long term, the fact is that we live in a system of perpetual inflation. As the dollar constantly loses purchasing power, that means real assets like real estate typically see the benefit of prices rising in conjunction with a falling dollar, which is why it's such a great hedge against inflation. In the end, as long as rates stay relatively reasonable, and for those of you who've been only paying attention during the recent years of sub 4% interest rates, yes, 5 to 6% is still reasonable, and lenders continue to keep liquidity in the market, I believe overall the real estate market will continue to be strong. We'll likely see more historically normal appreciation levels this year, but with such a shortage of housing, rents could continue to see higher growth in high demand markets. Just a reminder here that real estate is local, and even with a strong overall national housing market, it's absolutely possible for one market to continue to struggle with inventory and have a supply and demand imbalance that keeps pushing pricing up, while another market gets overbuilt and ends up with a supply surplus and potentially declining prices. National statistics are great for a broad picture, but always look at whatever local markets you're involved in to get a better idea of what things are going on and where things could be going on that level. If you're considering buying, now is still a good time to buy. Remember to buy with a long-term approach, and that if and when rates do come back down again, you can always refinance into a lower rate. As an investor, I'm always a buyer, and you should be too. Just be going into any investment with that same long-term perspective. Avoid being speculative, cover your downside, and buy in solid markets with great economics, and you'll do well in the end. As the real estate guys say all the time, you can't make money on real estate that you don't own, so don't wait. The best time to buy was, of course, years ago, but the second best time is today. Keep an eye out for some exciting announcements as I'm continuing to build my podcast. I'm looking forward to putting together some great tools to help investors, as well as an exclusive community just for podcast listeners to connect with myself and with other investors. So stay tuned for that and more. Thanks everyone, as always, for watching, and make it a great rest of the day.